98% of Airbnbs that are live and listed, no matter what duration of the year, doesn't matter if it's part-time, full-time, doesn't matter, they're run by individuals who either use the house part-time or they only own one or two, but there's no one who's really like owning and creating market share in certain markets and really understanding what the ideal consumer or guest is looking for when they stay in these markets.
Okay, so we have a thesis that the managing body of California makes it so difficult to build anything that they have artificially made our market undersupplied. And so we believe that the state makes it so undesirable for other investors that the state keeps our competition out for us.
So you figured out how to find sellers of real estate to paid traffic.
The way this works is this is people-based targeting, not property-based targeting. We have to think like, what are these platforms made for and what are they good at? And we have to use them that way that they're made to be used.
There's a line in the sand that's drawn between Airbnb and multifamily.
Right.
It's not a rinse and repeat. I think that was a lot of people ask, like, what was the hardest thing about scaling your business? Because we're vertically integrated. So we raise all of our capital. That's a business in itself. We acquire all of our homes. That's a business in itself. We operate all of our homes internally, meaning we design, furnish everything in-house, and we manage. Oh, wow. So we're integrated. We're basically three businesses in one. And the hardest thing was to realize that each house is a little business, and you can't just throw a washer dryer and a backsplash and get a new operator like you would do with a 200 unit with multifamily and expect the same thing over and over again. I mean, right. These houses have quirkiness about them. A lot of Airbnb homes have converted spaces, like a converted garage game room or a bedroom that acts as a 5-bedroom, but on resale, it might be different, right? So every house is so different. It's definitely hospitality. There's a service involved.
Yeah. Explain us your business model, how that works.
So we are a fund, and we like to offer a passive investment for people who want to diversify their portfolio and maybe get a taste of what short-term rentals are the easy way. So we're very data-driven. So we have a team internally that focuses on we built our own software coming from a tech background. So my business partner also worked for Facebook. And when we started getting into Airbnb, we were like, gosh, how do we find markets to invest in? There were so many markets, especially single family. It's a way smaller investment than buying a hotel or a large building. So we created a software. It runs, every listing on the MLS in the United States. It spits out properties that numerically fit our pro forma and what we're underwriting for. And then obviously our data team comes in and analyzes all these homes. So what's a good space for a hot tub? Is there a room to remodel a kitchen or a backyard? And we look at the highest grossing homes on Airbnb, why they do really well. And we created a acquisition model that basically does that for our fund. So we buy properties in that sense. And then we have an entire operations team. I run everything operationally in the company that flies out to the properties. We do the inspection reports. We remodel every home. Every home has accent walls and artwork and themes. We have like a Barbie themed home. We focus on that part of the business. And then internally, we also have property management, and we manage our properties internally as well. So we're fully integrated. We're fully into, what is it called? Integrated. Vertically integrated. Sorry. And we do that. Everything from short-term rentals A to Z we do.
Wow. That's a lot of work, I imagine.
Yeah.
So how big is your team right now? I think something around 20-something people?
I think right now we're a little over 30 people.
Oh, 30. Very good. Very cool.
And we're
all local, or is it a virtual team?
So it's a fully remote team.
Okay.
Most of our team lives in San Diego, and we have a few people in upstate New York. We're kind of all over the place. We're in 10 markets right now where all of our properties are located, and we have around 85 properties.
Wow.
I think when we started the business, when we looked at the industry as a whole, I think, and I can't be 100% quoted to this because it's been a year, but at the time it was like 98% of Airbnbs that are live and listed, no matter what duration of the year, doesn't matter if it's part-time, full-time, doesn't matter. They're run by individuals who either use the house part-time or they only own one or two, but there's no one who's really like owning and creating market share in certain markets and really understanding what the ideal consumer or guest is looking for when they stay in these markets. So a lot of the times you have plenty of saturation and competition, but it's not someone offering the whole product at what a guest that's coming into that market and what they're looking for when they stay there. For an example, again, we're led by data, so all of our homes offer all the amenities that people look for when they come to that market. We have the right photography. We know how to create listing descriptions that are created from a company perspective. So, and we also own a lot of the homes in that market. If you were to look up Scottsdale for Super Bowl weekend, most of our properties are booked already. But if you were to just take a snippet of a calendar time frame, you will see probably 10 of our listings, and they all come up first. So Airbnb has its own search ranking similar to SEO. It's in Airbnb. They're favored for many different variables, for pricing, for the number of clicks that people, the traffic, the clickbait, the amount of guests that are looking at photos of each listing. So we rank high. So us personally, if anything, our revenue has gone up, but we also know what we're advertising.
You're basically saying, yeah, there's competition. You just got to be better than the competition.
You just got to know what you're offering, and you got to know what people are looking for. Like every season in our seasonal markets, like we're not offering pictures of snow in our properties. We change all of our photos to show fall leaves or summer, and those get booked the highest. I'm not offering a pool in the Poconos with beach chairs. I'm offering a hot tub, a sauna, warm towels, a place to hang your skis, and we change our photos, in that change of season, so that we keep ranking high. I mean, there's so many little strategies that come with owning a home, but again, we do it as a company.
Did you just learn those strategies little by little, or?
I think little by little, and then obviously looking at other properties who do really well. But now we comp to those who do really well, like at the 95th percentile, but we also comp to our own at this point. I've A/B tested many of our own homes. Like, okay, I'm going to redo a bathroom in this one. It's the same exact floor plan as the other one. I'm going to save $11,000 on this one, and then this one I'm not going to renovate. And I am going to renovate it. I'm not going to renovate it. They both produce the same revenue. Next time I'm not going to renovate the bathroom. So we've changed our strategy with time, but we're always data forward. Another thing too is that Airbnb, the typical Airbnb investor, it's an accident. My wife is going to design it, and we're going to use it.
They're just like.
But it's very emotional.
Yeah.
We are not emotional at all. We look at data. We look at the numbers. We look at amenities. We execute on those amenities. We list, and we're very fun. We fine tune our revenue based on if there's any room to be better, or if we can leave it as is and it's performing to what we thought it would be. And that's how we look at our business. But Airbnb is very emotional.
Yeah.
In general.
It is because it's like their mom's house or their sister's house or their former home, and it just kept, and now the tenant moved out. Oh, let's just try Airbnb. So they put like some leftover furniture that I have something in there, and it just doesn't all look well put together, right?
But there are also, it depends on, so when we look at Airbnb, I also think that there's so many different types of properties. Like I know a girl who owns a house that's shaped like a potato in Idaho, and she built this potato by herself, and she does really well doing it. And I'm not going to go build a potato, right? No. Like that's her little baby, and she does really well, but we're a business. So there are people who have tree houses and tiki huts and igloos, and they do really well. But we have a very specific thing that we buy. We buy 4 to 5 bedrooms. We buy, this size property with this size yard in these markets, and that's our bread and butter, and that's our consumer too.
So then now let's jump right into it. Like literally every person I talk to that's invests in multifamily or self-storage, self-storage not that much, but multifamily basically says like stick to the red states where you can evict people if necessary faster, where you have where you don't deal with all this different kind of things. Like for example, we just last week closed on 91 units multifamily property in Fort Worth, Texas, and in Texas, if somebody doesn't pay the rent by the 25th of the month, they're out the door with literally the police or the sheriff coming and moving the furniture out the door and onto the sidewalk. So how does that compare to California, first of all? And what is your reasoning behind investing in California out of all places, even though prices are sky high, cash flow might not be strong? These are all the stereotypes that I'm going to throw at you right now, and I want to see what you say to them. Prices are high, cash flow is low, you can't evict people, government is horribly pro renters, etc., etc., etc. So give it to me. What do you got?
Okay, so we have a thesis that the government or the managing body of California makes it so difficult to build anything that they have artificially made our market undersupplied. So California, I mean, when you look at economies, we're the fourth largest economy if we were a country in the entire world. It's a massive, massive market here. There's a lot of demand. And so when you have that type of demand and a government that makes it very difficult to build, our market becomes off kilted. It's demand up here and supply down here. And so we believe that the state makes it so undesirable for other investors that the state keeps our competition out for us. And when competition is out and the market is undersupplied, that drives your rents up, that drives your values up. So you kind of touched on the point that there's not a lot of cash flow and valuations are really high. Well, we think valuations are really high because there's just not enough product and too many people are bidding on a limited supply. And second, we build. So we don't buy stabilized or existing assets. We buy distressed assets that we can get at a discount. And then we build it to what we refer to as our yield on cost, or maybe you could think of it as we're building it to a better cap rate than the market currently offers. And so we end up getting pretty good cash flow. But yeah, I guess we have the outlook that the government is so bad at doing this that they keep anyone who owns real estate in California's prices up.
Well, that's certainly that. I would agree with that. They're doing a tremendous job at that, California, at basically making it so difficult and keeping the reputation of California for real estate investors so low and so bad that nobody wants to move there. So there's a good point, and that's a really cool contrarian move there. Having said that, are you not concerned about the tenants that stay forever and that you can't evict, or how are you protecting yourself from that aspect?
Yeah, so I'll start by saying we've owned real estate here for a long, long time. And we have never been in a scenario where somebody has stopped paying us and they've ended up having a free place to live for 2, 3, 4 years. We've never experienced that. So, one thing that is important to note that when you develop in California, you have a little bit more flexibility on where rents are going to land. Where it's harder for investors is maybe those that do value add syndications or value add kind of opportunities where they buy something that has rents below market and then they renovate them and then they try to drive rents up. That is more difficult in our state. So there's definitely that. I would say Texas is actually a good example. Idaho is a good example. There's markets that are very easy to develop. And when markets are easy to develop, you see the typical developer cycle, which is there's more demand than supply. So developers come in and build. We overbuild. That's what we do. And once you overbuild, all of a sudden you struggle to lease up. So then you start giving concessions and then discounted rents. And then all of a sudden the cost no longer makes sense to rent, the cost no longer makes sense to build. And then you see the market correct. That's the typical cycle. In California, it just doesn't happen. They don't allow the market to ever get to that point of oversaturation. And so we don't see it basically correct the way it should. I would say we should have seen that a year ago, the way you're starting to see in Austin where prices are correcting. You should have seen that with the way interest rates moved. The only reason it didn't is because we're, as of right now, 2 million units short in the state. So I think it comes down to this. When you're a policymaker, a lot of times they look at trying to solve one problem and they don't look at what the additional effects will be to that policy change. And then they end up in a lot of cases building or creating a bigger challenge than they had leading up to it. So right now in LA County, LA City, you have the mansion tax, right? So they started giving an additional tax for anything you sell over $5 million of value. And they're doing that so that they can then take that tax and build housing for the homeless, right? Well, what they don't realize is by doing that, you're now limiting the amount of transactions. And when you limit the amount of transactions, or you limit the people that want to develop, you're only putting a more significant supply constraint into the market. And so they're inadvertently continuously making real estate investors wealthy. It's insane. Their policies are directed towards the renter, and all they do is make owners wealthy.
So in that case, what did that lead to? Let's talk about that. So you the wealth tax. How large is the wealth tax on and it is on single families or on multifamily too?
It's multifamily as well.
Okay. So anyone that sells anything over $5 million pays how much in tax?
I think it's an extra 4%, I believe.
Okay. So and what that has led to, that people just don't sell?
It's led to people basically not selling, and it's led to more and more investors not wanting to build new real estate here, or at least in LA City. Now, the state of California is a lot larger than LA City.
Sure,
LA City's arguably the most progressive city with San Francisco that kind of exists in the state. But yeah, they have made it so I don't think they're going to catch up to demand now.
Okay. So, and as a result, basically what is in the market has only become more valuable, not necessarily to cash out on, but you could always, because of that, go and actually borrow money out of it and keep your property, just keep borrowing against it and just keep it, which is what the wealthy, to some degree, already do anyway.
Right. Correct.
Right. Okay, cool. So you said you're more in control of where the rent's going to land because you're building. And that makes sense. But I just want to make sure that for those who are perhaps listening or watching and not familiar with particularly the rules in California, which includes me, is that what you're basically saying that is if you're building brand new, you can set the rents wherever you want them as long as you can get them. There's no restriction. You don't have to follow any kind of law that it needs to be within a certain dollar amount of average rent or things like that. You can, to some degree, say like, hey, I want to charge $5,000 a unit. I charge $5,000 a unit. If you buy existing properties that are renting at $1,000 or $2,000 a unit, you can't just randomly increase them to $5,000 a unit because there's laws in place that allow like rent control and renting kind of. Is it rent control or is it kind of limited rent control or is it?
Yeah, there's rent control, and then there's certain markets that have, different regulation on that. But basically you're capped on how much you can increase rents each year. And then in certain markets, you're capped on basically setting the new rent. So if somebody comes in to a, older Class C property, and somebody leaves, and all of a sudden they renovate the whole unit and try to double the rents. In some markets, they don't let you do that anymore.
Okay. And that makes sense. So in that case, it is absolutely what you guys are doing makes total sense. Now, the third reason I think it makes sense what you're doing is in this particular configuration is that you're not building Class C properties. You're building because from what I can tell, what kind of experience is that the people that are becoming the squatters and that stay in these properties for a long time are the people who are gaming the system, and that's typically not the one that can afford a $5,000 a month unit. That's typically not the ones that can afford the Class A unit and then drive up with their Mercedes, have a good paying job. And those kind of people, they care about their credit. They care about their credit worthiness and whether or not they're being evicted or not and things like that. So by being in that market, you're doing the smart thing, which is to go to the Class A property, Class A tenant, where probably as you mentioned, these eviction kind of issues just simply don't exist, right?
Right. You see honestly, you see the eviction or the people that really understand the law. You see that more at play with like slumlords. It's like the person that bought an asset, never took care of it, didn't really raise rents. It was more of like the old school philosophy, which was just make sure no one ever leaves and I'm good. And so it's created a scenario where people's rent is so far below actual market value. And then once somebody comes in to buy it, seeing that, the income coming in from the asset has room for them to raise rents, that's typically the ones that have a hard time in the eviction process. It's new investors that come in that try to do a value add, and the old tenants paying such a discounted rent understand the laws, and then basically have a huge price tag to remove them.
Okay. And that again, that makes sense. So this is, again, it's a good example of how to not stereotype just one state across the board, because within the states there's different kind of games that you can play and different kind of models you can pursue. And to be honest, this makes sense. This makes sense. I mean, going into a California market where there's, you mentioned 2 million units, lack of, like, there's underbuilt by 2 million units, where it makes it harder and harder to build, and going in there and going to the extra effort to actually build, and then being able to build a Class A space that has tremendous valuation that you can actually get market rents for, is actually a very, very smart thing to do. So congratulations, that's well thought out. So you figured out how to find sellers of real estate to paid traffic. Now, again, we all use, in the real estate world, we all typically use direct mail to get sellers. How do we know how to target somebody that wants to buy a house? So walk us through how you figured out how to find the right buyer, how to find the right sellers of land. And we'll talk about the buyers too, but particularly on the selling side, it's been the hard thing, because there's very few criteria that indicate that somebody basically says, yes, I want to sell my land.
Yeah, totally understandable. And it's a interesting way, because when we're used to doing things like direct mail and we're used to targeting things like lists, then you're used to identifying who is the person at the end that we want to reach. And then you reverse engineer how to get in contact with that person, whether it's cold call
Right.
or direct mail or whatever the case is. And the way that you're pulling their information is usually by property information, versus if we're going to online marketing, the data points look completely different. But just think about it. Just like public records can tell you, like, what kinds of land do they own and where is it? And you can know different characteristics about that. Someone's online activity tells you a lot about them. Like what kind of websites they visit tells you what kind of things are they interested in. You can connect their behavior online back to, or at least ad platforms connect it back to, like, credit card history and purchases and demographic information and tax information, and intent-based information, which is really interesting. Like, people generally are going to precede a lot of the actions that they take in their life with a Google search, believe it or not. A Google search is more predictive of what someone's likely to do as their next action than almost anything else. Think of it like a good example is travel. If I'm searching for, like, flights to Florida, what's more predictive of me probably flying to Florida soon? The fact that I just searched for flights to Florida, or the fact that maybe I'm in some zip code where it's common that people want to fly to Florida, right? It's the fact that I just searched, right? And it's timely. It tells you that something's happening right now. So it's interesting. So the way this works is this is people-based targeting, not property-based targeting. And it's intent-based targeting, not demographic or situational-based targeting. So it's a little bit different. Well, number one, Google search is used for intent targeting. So if you're going to layer a list on top of what people are searching, one person from your list is going to search that month. And if you're lucky, you spend $20 on marketing that month. It's just not going to work. On social, it likes big audiences.
Because again, if you have a list of 10,000 people, first of all, the overlay, once you actually import it, is only 2,000 people. And then of those 2,000 or 4,000 people, another 4,000 people, since it's intent-based, you have to wait for them to search for something that you can actually pop up in front of them. And not everyone searches for the fact that they have land or have a house and looking to sell it. Doesn't mean that they're actively, constantly going in there and entering search terms for it.
Yes, 100%. Or if it's in social media, you've got your list of 4,000 people, and you've got what's called the CPM. This is your cost per 1,000 impressions on Facebook of $20. And only half of those 4,000 people are active on Facebook at some point during when you're wanting to bid, right? So you got 2,000 people, and so you spent $40 on ads to reach them all. And it's not like it's not like a waste of money. You could have a decent return on that $40, but you're not doing enough volume for it to really be worth it, because you're using a channel that likes a big audience, and then you're doing it with a really narrow audience. So that's where it's like that whole method of thinking, I think, is taking what works in other channels and pasting it onto online marketing. When the reality is we have to think, like, what are these platforms made for and what are they good at? And we have to use them that way that they're made to be used, and I can explain briefly how that targeting works. There's so obviously it's going to be different per channel. We're going to have Google PPC, and then we're going to have Facebook ads. Those are the core channels that we're doing from a paid ad standpoint. And Facebook ads is going to be your very much you're targeting a lot of people, and they're self-qualifying. So you're going to reach a ton of people, like more than you're probably used to for direct mail. Because direct mail, you might pay 40 cents or $1 to send whatever you're going to send, be it postcard or letter or whatever. Facebook, you're going to pay like 2 cents to get in front of them. But the rate at which they respond to that's much lower, right? So your funnels just cuts off a lot of people at each stage. It's more of a mass form of marketing. And then Google, on the other hand, is intent-based, right? So we're thinking, well, maybe I don't know exactly which property I'm going after, but I know that somebody who's geographically located in this area is searching for a way to sell their land. That tells me that maybe they could be a good fit for me. And then you generate leads. And then the key to this is where I've seen other people go.
So they're searching, and you're basically doing pay-per-click. So when they're searching for like looking to sell my 20 acres, then you have put ads in the background that basically have certain of those keywords that get triggered when they search for that, and your results come up. It's like, yeah, I'm buying land. And then they click on it, they fill out the form, and you pass that on to your customer, because in this case, they basically self-identified as having a piece of land to sell, and they reacted to your ad and gave you their information.
Exactly. And that's,
okay.
Yep. And a lot of people think that's where it ends. In my mind, that's kind of the start of the targeting, because you got that. And then this is where, like, that is where a lot of marketers end, but where you really get success with these platforms is you do a really good job of understanding, was that lead the type of lead that we want or not? And that could be, are they actually interested in selling or stuff? And it could also be, is it the type of land that we want? And then we make adjustments to dial in on just the right leads, which often includes, like, just to give you an example of how this would work, we'd be filtering people in our forms, like asking them questions. Like, let's just say you buy a minimum of 5 acres at a time. Like, you're not interested in a parcel of land that's lower than 5 acres. In that case, what we would do is we would ask them as part of the form, how many acres is the land? If they say it's 6 acres, then what we're going to do is we're going to tell Google that was a good lead. Give me more of that. If they say it's less than 6 acres or less than 5 acres, then we're going to tell Google that's not a good lead. We don't want more of those. And then what we do is we keep on doing that over and over again. And then Google starts to use its tens of thousands of data points it has per user to better understand how to find you the leads you want. So instead of it being that I look for start with the land that I want and then reverse engineer how to get there, I start with the type of lead I want. And then I give feedback to the platform so it learns how to find that type of lead for me. So a lot of people do this stuff and they end up with a bad quality lead and then they give up, when really they just kind of started the process. But that's how ad platforms really optimize over time, is that you give them that feedback on what's a good lead, what's a bad lead. And we found that we can increase the lead quality pretty significantly that way.
All right. Well, that is really cool. And that is certainly, I think, a little bit different than the fly-by-night kind of advertising person that just basically goes and says, like, yeah, put some ads up there and gets the first level lead, like, hey, here, and then sends you some random stuff. So basically what you're saying is that with you, people can actually get fairly specific with what they're looking for, and then only get fed the kind of leads that actually make sense for them.
Yes. Well, sort of.
Not perfectly, of course, right? But in a tendency. So if somebody says, I only want to deal with 10 acre plus, you're not gonna feed them a series of 1/4 acre lots.
So the way that it would work is we do a few things. So targeting actually happens. Think of it like this. Let me compare this to fishing. A lot of the way that people would do this, if we're just comparing it to fishing, they would say, well, I know that the fish that I want to catch, maybe the particular type that I want to catch, is right there. So cast right there. That's how we're going to catch that fish. The way we do it is we change the bait. I want the bait that goes out to be the type of bait that only the fish that I want to catch would actually bite. Right. And that's how I target, right? So it's just a little bit different. So what we end up doing is, for example, in the ad, if somebody searches like how to sell my land, we're going to show up in the ad, but we're probably going to say right in the ad, 10+ acre properties only, or whatever we want to say. Because remember, this is pay per click marketing, right? So if they don't click, you don't have to pay anything. So we're going to say right in the headline, like, don't click this if you're not this person, right? So we qualify right there. And then as they fill out the form, we're going to ask them, well, how many acres is it? And if it's not the right kind, then we're going to tell Google, hey, no more of those. We don't want those. And it's never going to be perfect. You're going to get all kinds of random leads coming through. You could filter them out based on the form if you wanted to filter them out. The way we view it is like, if we already paid for the lead, we'll send it to our client. But if it's not the one that we want, then we'll do everything we can to get more of the type that we want in the future. But we still will send along anything that comes through the form.